the one that's not thought about the most, but the one that's from a probability perspective is the most likely to happen, is in the event that there's a relationship breakdown. So having your assets in different structures does not prevent it from family court proceedings if your relationship breaks down.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are. 360 Money Matters podcast on a Friday again.
Andrew, this is true. And this is episode, I don't even know, 164, maybe? 363 coming to everybody over the airways, over the wireless.
So many episodes.
It's pretty exciting what started as a bit of a project during COVID, and here we are.
Yeah, I know.
Love it.
I know. And now we're 163 episodes deep. Who would have thought that we have that much to talk about?
That's it. No, well, we've got plenty to talk about, but people actually listen and continue to do so, and the numbers and the stats keep going up. Obviously, we're doing something right. So on that note, Andrew, what are we talking to everybody about today?
Yeah, look, today talking a little bit about been getting some questions lately around whether people should be buying assets in a trust. So talking a little bit about ownership of assets, touching a little bit on trust ownership through a company, or whether you just keep things simple and, own assets individually, and sort of some of the pros and cons associated with all of that.
Right. I always find this conversation interesting because it's one of those things that when you enter into a decision, or at least in our world anyway, but when we're making a decision and recommending some advice for a client, we're constantly going through these trade-offs and going, okay, is option A better than option B? And if it is, how come and why not? And what are we foregoing and what's the advantage and so on and so forth? So I think really in this instance, it's explaining that there's a trade-off between going down one particular, this will make more sense later, I promise, but going down one particular pathway versus the other. The thing that I think about with investing in different structures is really for two critical things. There's probably a third element as well too, but asset protection is definitely the first one, and the second one is from a tax minimization perspective. They're really the main two, and there's little offshoots that are associated with both of those. But really, if you're looking at doing or achieving one or two of those two things, then that kind of opens up the door to say, okay, yep, you've passed that first hurdle. Do I want to protect my assets because I'm a small business owner and I'm worried about creditors, or am I paying too much tax, or have I got a particular family situation where I could potentially share some income with some of my family members?
Yeah. And look, the asset protection one is a really interesting point, just because some people think that if you own a property or if you own assets in a trust, then it means that no one can ever take it and it's bulletproof, and that's not the case. It makes things more difficult, and it can mean that it's more cumbersome for someone to be able to access your assets in the event that you were to, for instance, do something nefarious or whatever it is where someone's coming after your assets. But it doesn't mean that your assets are bulletproof. It's just providing a layer of protection. It's basically like just wearing another piece of armor is ultimately the way that I think about it.
Yeah, it makes it a little bit more complicated, right?
Yeah, exactly right. But definitely doesn't mean that you're bulletproof. Can't run through a wall with it.
We'll talk about the asset protection piece later, because I take a bit of a different stance on it. We'll get to that later. Yeah. I might keep that up my sleeve for that one. Andrew, so a couple of different types of trusts that we think about and we talk to people about. So we've got a unit trust or a discretionary family trust are usually the main two ones there. You want to run us through what they look like?
I mean, depending on your circumstances, one might be more appropriate than the other. So to use an example, let's say two business partners, they decide to purchase a asset together. they're more likely to be purchasing that asset in a unit trust, because you basically want to say, hey, Billy, you put in 60%, I put in 40%. So you own 60% of the units and I own 40% of the units. Now, in that instance, if there's a profit, 60% gets distributed to you, 40% gets distributed to me, versus a discretionary trust whereby you choose every year who receives and who gets the profit distributions out of that trust. So something like a family dynamic, like for instance, my wife and I, me and Stacey will own assets within a trust so that we can decide, okay, in this particular year, we're going to distribute assets because, Stacey was on maternity leave for a period of time or whatnot to one particular party versus another party.
Yeah, so basically it just gives you more flexibility. And I guess the one that we see most commonly used and most commonly recommended, at least within a family unit, is that discretionary family trust.
Yep.
Whereas if it's with two related parties that may not necessarily be relatives, it's something usually like a unit trust.
Yeah, exactly right.
Yep.
Exactly right.
Some of the things to consider with the with even going down this, so coming back to that trade-off discussion that I was talking about before, the cost and the complexity of establishing and running that actual extra entity essentially. Yeah. So you need to think about, okay, it sounds good. It definitely sounds good on paper and it's a really commonly used vehicle, but if you're going to do that and spend the thousands and thousands of dollars to set it up and then the additional amount of money each and every year to make sure that it's doing its tax returns and doing its thing, the vehicle, the assets that are owned by that vehicle need to be plentiful enough to be able to then offset the cost associated with the setting up and the running of it as well too. So it's not just like, okay, yep, I'm going to go do it and then buy a share portfolio worth $10,000 and that's it. That would make no sense whatsoever because your cost, going back to that trade-off conversation, your cost doesn't outweigh the advantage that you get from it.
Yeah, and just the burden of it as well. You need to do a tax return for the trust every year. You need to, make sure that it's distributing all of its, well, you're not doing a tax return per se, but you're distributing all of its profits out of it. So it is another burden. It is another thing that you need to ultimately manage above and beyond the costs. And when you do talk about costs, one of the other things to consider is the implications, particularly with property, not to such a degree when you're talking about, shares or managed funds or something like that. But with property, there's a couple of things where you really need to consider if a trust is appropriate. One, cost of stamp duty is more expensive when you're owning a property through a trust. The land tax associated with a property owned through a trust is also more expensive. And I know that that's been a pretty big issue for a lot of investors in Victoria.
Yeah, Dan Andrews.
And there's also some more complexity when you're looking at borrowings in the name of a trust versus individual borrowings in two people. So it may limit your borrowing potential as well. So there's a few really big things to consider. And one of the other really massive things, particularly when it comes to property, is a trust is able to distribute its profits, but it cannot distribute losses. So what that means is, let's say that you've got a property that's held within a trust. If it's positively geared, you will need to distribute the profits. So let's say it makes, a $20,000 profit in a year, you will need to kick out $20,000 out of that trust to the owners, in essence, of the trust. If the profit, or if it makes a loss, so you're talking negative gearing here, you can't actually distribute those losses. So you can't get a tax deduction on an income loss when an asset is held within a trust. And so where, maybe, and this is probably a really good example of, you might have purchased a property, say 3 or 4 years ago, where interest rates were at 2%, positively geared. Well, I'd probably, the right thing to do is maybe purchase it in a trust because I can, in essence, decide who receives all of those profits and capital gains in the future, which we'll talk about. But interest rates have gone up. You're now at a position where maybe that property is now negatively geared, and all of a sudden you've got a negatively geared property where if you were owning it individually, you wouldn't be incurring the additional costs of owning it in a trust, and you'd be getting a tax deduction on the negative gearing. Whereas if it's owned within a trust, you've in essence lost the benefits of negative gearing, and you've paid to lose those benefits as well.
Yeah, and that's something that we're seeing because of the interest rate movement. It's really common at this point in time. And that's the thing too with this, and we always advocate for advice, but if you get it wrong at the start, it becomes very costly down the track if you wanted to fix that and remedy it. In this instance, it'd mean transferring the profit and transferring the property and paying stamp duty and bits and pieces again. So probably not an ideal situation. Talking about the distribution of income and capital gains, once again, being in a trust, it gives you we're talking about a discretionary trust, not necessarily a unit trust, because a unit trust, you have to do it in your percentages. Yeah. But with a discretionary trust, you get to then pick who receives that. So as an example, and you alluded to it before, Andrew, you might have, let's say you've got a property that's owned within a trust and you've got two members of a couple and you want to, one of them's older, so they're going to retire first. They'll receive all of their retirement income from superannuation, so there's no taxable income. You may decide to sell that asset in the year when they're receiving zero taxable income and push that through their name, because it's not like you're working your way through the tax brackets as opposed to just adding it on to the income that you've earned for that year.
Yeah.
So that's a really common strategy as well too, to be able to alter who's paying the tax to try and suit your circumstances and basically the tax rate that the people are on at that point in time.
Yeah, exactly right. And I think the difficulty when you're making these decisions and sort of some of the benefits of a trust is the flexibility that it provides you is you don't know necessarily where your circumstances are going to be. So a really common thing is, okay, I'm going to buy a property and it's going to be an investment property and I'm going to buy it in the partner who has the lower income. Mm-hmm. I'm going to buy it in their name because when I eventually sell the property, the capital gain is going to be on someone who has a lower income. Now, you compare and contrast that and say, okay, well, what if it was within a trust? You might, at the time of purchasing the property, that person's income is lower, but it could be higher by the time you decide to sell that property. Or let's say over the course of time and you've held those assets for a long period of time, you've now had kids and all of a sudden kids are over the age of 18 and you can use their tax bracket. And so rather than distributing to only one person or two people, you can now distribute it to, let's say, 4 people or 5 people. So the benefit of really, ownership within a trust is, as at day one, it may be beneficial to distribute income to one particular person, but as at, year 30, it might be to distribute income to another person, and a trust gives you that flexibility to be able to do it.
Yeah, so I think there's a really strong case from a tax minimization or a tax optimization strategy. It's probably a better way of calling it. I just want to pivot back to the asset protection piece. So the idea and the concept is basically really simple, that if you did something incorrect and somebody was pursuing you and they knew that you had assets, if you've got the assets in your personal name, they're easier for a creditor to attack. If they're owned in a different entity, like a trust, it becomes a little bit more challenging and just adds another layer of complexity. One of the interesting things when we talk about asset protection, and this is what I was alluding to before, is when you think about your main creditor, it would be probably your lender. So if you've got a mortgage with a particular bank, they're the ones that are going to, most likely.
I thought you were going to say your spouse.
Well, that's what I'm getting to, right? That's exactly what I'm getting to. Andrew, he's heard this story before, but you can't create this structure and sidestep your obligation to the bank.
Yeah.
No way known can you do that, right? They've got it tied up. It really doesn't make a difference. Majority of the time we're talking property or business assets. There's personal guarantees. There's a whole range of stuff. So basically take that off the table. So it's more so thinking about creditors in the line of maybe conducting your business where you're taking some trade credit because you bought supplies on an account, something like that. But Andrew, you mentioned it before. The one that I think is probably the one that's not thought about the most, but the one that's from a probability perspective is the most likely to happen is in the event that there's a relationship breakdown. So having your assets in different structures does not prevent it from family court proceedings if your relationship breaks down.
Yep.
So that's probably the other one that's an interesting one to point out, because it's not like you can use these vehicles and these structures to be able to try and sidestep and avoid that. Basically, family law trumps everything, and everything gets thrown into the bucket regardless of where it's owned.
Yep, exactly right. So for people, which look, we've had inquiries of it many times before, is, hey, what if I put my assets into a trust in order to be able to, protect it from a relationship breakdown? It doesn't work like that. All of your assets will be, in essence, used in family court proceedings. When you are talking about, a trust or a company or an individual, it doesn't actually matter who owns the asset. It won't make any difference whatsoever. The other thing that you do need to consider is if you're owning an asset in a trust, you can never utilize the exemption of it being an owner-occupied property.
Yep.
So, if you decide to, move into a property and all of a sudden there's no capital gains over that period, it's always an investment property for the purpose of tax when you're assessing capital gains if that property is owned in a trust. Doesn't matter who's living in it, doesn't matter what's happening with it, it's always an investment property. So that's another really big thing to ultimately be careful with that.
So I think we've introduced the concept around it, and like anything, there's probably never really a straightforward answer with it because of the level of complexity and all of those trade-off conversations. In saying that, it's definitely worth exploring if it fits your circumstance. But once again, we always come back to it and we sound like a bit of a broken record with this stuff, but getting advice definitely makes sense because you want to get this stuff right at the start. Because if you don't and then realize that, hey, I've gone and done something and it's incorrect, or there's an optimal way to be able to do it, pivoting and then changing into that can be quite expensive and costly and cumbersome and a lot of admin involved and stuff. So getting advice around what this looks like, and then you can have a proper conversation, discovery around, okay, what are your primary objectives? And that would make the, the pathway clearer, as opposed to just going, yep, it sounds good, let's do it. Thinking through those consequences and what works and where it works and where it doesn't work, and making sure that you're comfortable with that when you go down that particular pathway.
Yeah, and truth be told, the amount of times that we will, sit in front of a client, and for one client, your advice is, hey, let's open up a trust, let's invest through a trust. For another client, it's, hey, let's, own this asset in this particular name, let's own this asset in a trust, for various reasons, because everyone's circumstances are different. So you really need to tailor not just your investment strategy, but also your ownership strategy around your investments really to your circumstances, because there can be really big ramifications if you don't.
Andrew, I think that was a good, short, sharp introduction to trusts around asset protection and tax minimisations. And hopefully our listeners and our viewers got a whole heap of benefit out that. If you did, don't forget to like and subscribe. Don't forget to share as well too. That really helps us to get to more people and continue to educate on our world, being financial advice. Andrew, thank you once again.
Thanks, Bills, and look forward to catching you all on the next one.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.